For years, investors have called this business one of the highest quality compounding stocks that you could buy, run by a superbly brilliant management team in an area with very high moats and a long history of a high return on capital. And then the stock fell 50%, and investors decided that this business is done and should be relegated into the dustbins of history as a mistake. Now, that may be a little extreme, but right now they are undergoing their largest stock drawdown ever. They're down 47%, which is much more than their second largest drawdown of 30%. Investor sentiment is as negative on the name as it has ever been, and that is largely because of two reasons we will get into in a moment. The name of this business is Constellation Software, and if you haven't heard of it, despite it being down almost 50%, it is still a 150 bagger since IPO in 2006. And it is run by Mark Leonard, who is known as sort of the Warren Buffett of Canada. And there's a lot of times you hear so-and-so is a Warren Buffett of some other sort of industry or geography, and it's usually not true, and they don't deserve that moniker. I think this honestly might be one of the rare exceptions, and we'll get into why in a moment. And with the stock down almost 50%, you're probably thinking that the financials must have deteriorated. Certainly, there must be some signs of pressure. But you'd be wrong. They've grown revenues at an 18% CAGR for over the last decade. Free cash flow has increased from $1.1 billion in 2023 to a little over $2 billion over the last 12 months. That is a huge increase in only a few years. And this is, again, despite investor sentiment being at an all-time negative. And so what is going on with this stock and what is going on with this business? Now, just before we get into all of this, you're probably wondering, why should you listen to me? Well, my name is Drew Cohen, and I used to work at Goldman Sachs in investment research, and then later at Capital Group, covering all sorts of different industries, including technology. I now am a registered investment advisor, but I also run Speedwell Research, which produces in-depth investment reports for professional investors. I actually wrote a report on Constellation Software back in September 2022. At the time, the stock in US dollars was trading around $1,500, and today it's now right around $2,000. And so despite this being one of the largest stock drawdowns, it's still up about 33%, but more impressively, since that time, free cash flow is up 150%. And so the stock price, since I wrote that report, is only up 33%, but the free cash flow is up 150%, which is honestly just a crazy metric because I was not expecting them to be able to grow free cash flow that much. And we'll talk more about why that is possible. Now, if you really want to go deep into this business, I also have a podcast where we did a full deep dive on Constellation Software. It is a 90-minute episode. We go deep into Constellation Software. I'll link it in the comments below so you can find that and listen to it. If after this video and you get this good overview, you want to go even deeper, you can do that. Also, for what it's worth, I did have an email correspondence with Mark Leonard. We sent him his research report, and he did note how thorough it was. And so if you do want to see the research report, you can find it at speedwellresearch.com. That is enough of a plug, though. And so getting back to Constellation Software, what you need to know is that these two key negative factors that are driving investor sentiment today is AI risk, as well as the fact that Mark Leonard stepped down. Now, we're going to talk a lot about AI risk in a moment, but we first need to give a little bit of context and overview of the business for those that aren't familiar. Of course, there's timestamps below, so you could jump ahead if you are familiar with Constellation Software. Now, this is a business that was started by Mark Leonard in the early 90s. He worked at a VC firm and noticed that some of their best investments were these vertical market software companies. In fact, he noticed the full TAM for these investments was only several $1 million in revenue, sometimes, just $5 million in revenue. And so there weren't a lot of natural buyers for this sort of business. And so the multiples they were selling for were really not that high. We were talking about 1 to 1.25 times revenue. And so he decided, what if I just create an investment fund that buys all of these vertical market market software companies at these super cheap multiples. And instead of worrying about reinvesting the cash flow back into the business itself, because they didn't really have those sort of reinvestment opportunities to do that, you just take the cash flow out and you go and buy more of these vertical market software companies with them. And so with that, it was kind of a little similar to Berkshire Hathaway. It's a holding company that owns investments permanently, and then it receives all the excess cash flow and just invests it elsewhere. And so he started that business back in the early 90s. He wanted to call it Software Holding Co. He got the advice that that is an awful name and he should not call it that. So instead he called it Constellation Software, which is an ode to the idea that all of these businesses he is buying are kind of these separate entities that are loosely held together by this sort of holding company. And so that was the original idea behind the business, and it went really well. They found a lot of these opportunities because people just weren't interested in buying these businesses. They were way too small for private equity, and so there just wasn't natural buyers for these businesses. So that is the opportunity he went after, and he acquired these businesses. Now, to give you some sense of the kind of businesses he's acquiring, you're talking about everything from bus scheduling software to cemetery software, a moving company, their software, chicken coop software, software for dentists, all of these very sort of niche applications that you would never run into in your regular life. There is software running these businesses, and it is very different than horizontal software, which is something like QuickBooks, which can apply to any industry, any business. Instead, it is only for someone who runs a cemetery, a chicken coop, a moving company. And so that is why it's vertical specific. And so what comes with that, though, is a totally different set of competitive advantages. Now, the first thing is that because the TAMs are so small, naturally, there's just not a lot of people vying to try to win market share. There's not going to be a lot of people that are leaving Stanford Business School to say, let me go disrupt the cemetery software business, the chicken coop software business. There's just not going to be that. Now, to the extent there are engineers that are trying to displace existing companies, and this is going to be similar to the AI risk we talk about in a little bit, once you actually get your product in the hands of the customer, it is very sticky. And it is sticky, one, because it is mission critical. Two, because it is a small cost relative to their overall expense base. Three, because a lot of times these businesses tend to customize the software with Constellation software. And so they get it kind of built the way they want. Four has to do with integrations, and just sort of general switching costs are very high. It's a huge headache. Look, what that actually means in reality, though, is imagine, you have a moving company. You help people move their furniture to their new homes. Great. You have maybe 10 people at this business, and most of them are movers. And so you have the software that schedules, what time to pick up, drop off people. And then maybe it also feeds into, where furniture is stored, whether or not they're paying up front or in the back, maybe any other notes having to deal with specifics. Is there stairs or not stairs? Do we have to take a big TV? Do we have to take anything off of the walls? Do we need to bring extra special packing stuff for a painting or for glass or a mirror, whatever it is? All of these very sort of specific idiosyncratic things to that business. Now, that business owner, once they get that software going, it satisfies their need basically. And so once it satisfies their need, they have no reason to really switch it out. So imagine now there's a competitor coming here. They say, I have better moving software. And you say, okay, cool. Like, what does it do that my software doesn't do? And maybe there's like one feature or something, but like probably not. And maybe they're just saying the UI is better. It looks cleaner. Maybe I'll charge you less. The moving company owner is going to say, well, if I rip this software out, I'm potentially messing up my scheduling. I'm potentially messing up my movers today. I could lose key customer information. I could have a total mess to deal with if I'm doing this. So I'm only going to do it if there's a big benefit. And what is the big benefit? Very often the answer is really not much. Maybe UI is probably the biggest one, but if there ever was a feature they really wanted, they would go to Constellation Software and they would get it built. There's actually a revenue line item in Constellation Software called professional service revenue. All that actually has to do with the service element of building the software, where they do have people come and they'll install the software. They'll help them customize things if they want something customized for them. So the software that's there is kind of already what they wanted. It's already serving their purposes. It's not the most beautiful stuff. Sometimes it looks like it's legacy, 90s, but at the same time, you don't want new software because then you have to retrain your employees on this new software. If the UI changes, you're losing efficiency. And so there's just really not much benefit. And if you think about Peter Thiel CEO, very successful VC investor, he talks about how you can't really disrupt an incumbent unless you come out with something that is 10x better. So if it's not 10x better, people are not going to go through the hassle of switching. And in many cases, if not all cases, the alternative software is just not better. That's why it tends to be very sticky. Customers very seldom leave. In fact, the most common reason they leave is bankruptcy. They no longer are in business. And so we'll touch back on this when we get to this AI risk, which is really key to understanding why the stock is down 47% and whether or not this is a potential opportunity. So that is some idea of the actual businesses they are buying. Now, Constellation Software itself, though, is just a holdco. So there's sort of the moats of the businesses they're buying, which I would say are pretty high because it's very hard to disrupt this. Once you have customers, they're not going to want to leave. The market isn't big enough to support more than one or two players. So new incumbents are really going to have to compete very aggressively on price. Even then, the customer's not going to care that much to switch because they just don't want to potentially lose revenue. It's just not worth it for them. And it's a huge headache. And it's like, is that really where I'm going to spend my time if I'm trying to grow the business? Probably not. And so those are kind of the moats within the vertical market software company. But then at the Constellation Software level, the HoldCo level, the moats really aren't that much. Leonard, the CEO, talks about how all you have to do to enter into business with them is to get a phone book and a checkbook. You could go and call on companies and you could offer them money. Now you're a competitor. And there actually are competitors to them, a lot of copycats that have popped up. The thing that these copycats then learned, and by the way, this was the risk that kind of existed with them a couple years ago that people talked about more. Now it's kind of faded into the background because what they figured out is actually a little harder. For starters, there's about over 70,000 of these vertical market software companies. Just finding all of them is hard. Calling them up, getting in touch with them, building a relationship with them, maintaining that relationship. So the one time and maybe 7 years from now that they decide they're open to selling, you're there and you're top of mind. All of that takes a big sort of M&A force, and it also takes a lot of effort. And on top of that, you also have to be a good steward of the business. When you're acquiring this business, if you just go ahead and fire everyone, raise pricing, then which is, kind of the typical PE MO, then you're not going to attract a lot of other business owners wanting to sell to you because a lot of times these business owners, they're running this business for 20 years, they care about their employees, they just want some capital and they don't have a lot of options. So they go to Constellation Software, but they don't want to see their company dismantled. If there's someone else that's going to offer them 20% more, but fire half of their employees, they're not going to want to take that offer. And so, some of them do just go for the money. Constellation Software doesn't win those, and that's okay. They don't need to win them all. They win enough. They do about 100 of these smaller $5 million-ish acquisitions a year, and that is their bread and butter M&A machine that has been going on for the past couple decades. Now, what has been a key risk with them is as they get bigger and bigger and bigger, it gets harder and harder to reinvest all of this capital. And that is really, even today, kind of the bigger risk. Can they continue to reinvest money at a 20% return on invested capital? I'll talk about the AI risk in a moment, but I'm telling you, this is the bigger risk right now that exists for them. Because when you're getting $2 billion of free cash flow now, that's a lot of M&A you have to do at $5 million in size in order to get that all filled up. However, what's been happening in the past couple of years, and the key reason why free cash flow has grown 150% over the last 3 years, is that they've now done these larger acquisitions. One of the first ones was Allscripts they did for about $700 million. If they could do just one of these larger acquisitions every year, then they're really going to have a longer runway of redeployment of capital, which is going to be really important in order for investors to get that high rate of return on their investment. We talk more about this in the podcast that's linked below if you want to hear more about that. But this is kind of a big picture overview of the business. They acquire these vertical market software companies, they hold them, they take the cash flow, and they reinvest that cash flow out elsewhere. Now, one of the criticisms they often get is that the businesses they're buying are not growth businesses. Yeah, that's absolutely true. Very often these end markets are not growing much and they're already fully dominated, so there's just not much in the way of growth. Pricing per customer may increase around 6 to 8% a year, which is a mix of them rolling out new features and charging for them, plus just taking pricing up. And then that's offset by churn, which is again, usually businesses going out of business. And that usually gets them to organic growth of anywhere between 1 and 3%. So that's another reason why this isn't an exciting business for a lot of other people to own. But what they figured out was that as long as you're paying a very low price, It doesn't matter if they're not growing that much. The cash flow they're generating is just a lot, and it's very easy to get that 20% return on invested capital if you're paying, 1 to 2 times revenue multiples for these businesses. And so that was kind of the genius of the business model. Don't worry that the growth really isn't that high. The capital we're going to pull out of the business, we're not putting back into it. We're putting it elsewhere. And so that's why this model really works and why it's disinteresting to a lot of other people. And as I was saying, though, one of the key risks people had for this is that they're buying a lot of melting ice cubes. You're going to buy this business and it's going to be irrelevant 10 years from now, continuing to shrink. And then, you're left with nothing. Well, I'm not going to lie to you. They do have a good amount of businesses they own that probably are shrinking every year. They own software to help run, linear TV stations. Linear TV is not the business of the future, as we all know. But if you're paying a low enough price for it, you're just getting a lot of cash flow in the meantime. Maybe sure, the cash flow doesn't exist longer than 10 years and it drops a little bit every year. But as long as you have that cash flow and you're putting it elsewhere, it's not a problem. They do the math on their return on invested capital and they use very conservative assumptions, which again is another reason why competitors have messed up. They don't know the right assumptions of churn to use because they don't have the data that Constellation has. And so they're able to model this out. It doesn't need to be a business you own for 50 years in order to be a good investment. It's okay if it shrinks as long as you're not paying a lot of money. And so that's one of the key things bears didn't like about Constellation Software. But again, they have a long history of a really good return on invested capital. The real risk is that they just don't have unlimited opportunities. However, I mentioned though, there's over 70,000 of these companies and there's more of them being built every day in these very niche sort of markets. And so if anything, AI could potentially mean there's even more companies for them to buy in the future. Not to mention they could use AI in their own products to reiterate and grow quicker, basically with fewer engineering resources. I'll talk more about that in a moment, but that is kind of the overview of Constellation Software. I want to say one other thing though. There are these two operating groups they split off, Topicus and Lumine. I'm not going to touch on that in this video, but just know those exist. We talk about them more in the podcast linked below if you want to read more about that, or we talk about it a lot on the Speedwell Research website. So you could check out more about them there. Now, let us get into the big AI risk and the key reasons why the stock is having its largest drawdown ever. So AI risk. Now, the first thing I want to say on this is that the advantages of vertical market software never stemmed from the fact that there weren't competition or that barriers to entry were high. In fact, barriers to entry in this industry are very low. The reason why is because the software is not that great usually. It's not that complicated. It's not that advanced. It's very simple things that it is accomplishing. And it usually would only take one engineer, maybe 2 engineers, not that long to spin up a software product. And they could have a very good, if not better, cleaner design, better UI, maybe even some other features in it that's better than the existing alternative. So why hasn't this been an issue? This is because just because something exists doesn't mean that people are going to use it. Now, the first sort of barrier you have, if you did create a software product, let's say you AI vibe coded it on Claude, is that how are you going to find where to sell it to? That is going to be a very big problem for you. You're going to have to pay a lot in advertising. You're going to have to pay a lot to find the customers. Once you find a customer, you're going to have a sales force. This sales force is going to have to convince them that your product is just as good as their existing one. Now, maybe you're thinking, well, I'll have better UI and I'm going to use AI to sort of iterate it quicker. Well, if customers cared about that, Constellation Software could already do that. And by the way, they're already embedded and integrated with Constellation Software. It has all their data. And then they also don't have to go through the massive headache of ripping out their existing enterprise resource system to replace it with something that potentially is erroneous, doesn't integrate as well, or doesn't actually end up serving the functionality that they want, not to mention the fact that they could lose revenues from existing customers in the process. And so for all those reasons, it's just kind of a terrible idea. And this goes back to the thing we were saying about Peter Thiel, how you have to have a product that's 10 times better. What is the benefit of software that is AI generated that the customer cares about? People are thinking way too much from the perspective of a financial analyst saying, well, if I vibe code it, it's a little bit cheaper. I can fire an engineer or something, and maybe I'll just charge less for the product. An average dentist doesn't care that you vibe coded it. They actually may be more scared about that, and rightfully so, because there could be errors in it. And if there are errors in it, where's your support team? Are you going to come out to the actual dental office and fix the software? And by the way, a lot of the software offerings they have, They're not on the internet. In fact, a lot of these businesses are so old and antiquated, they're using what is called on-prem software. That means there's a physical disk they load onto a server that's on premise, and that is their software that is running the business. And that part of the professional service revenue they have is from helping set up those systems as well as selling them hardware to do that. So now you're talking about ripping out literal hardware, an entire on-prem system, which, by the way, they didn't even care enough when things went SaaS to do this. And so what is the benefit at this point to the customer? That is really kind of one of my pet peeves about this whole thing. Just because something exists doesn't mean it's better. Just because you could do something cheaper doesn't mean it does anything for the customer. The customer's needs are fully met by the existing software, period. And so if you were coming in and trying to displace their software, you're going to have to do something for them that is not currently being offered. And it being a cost savings to you or charging a little less is not going to be sufficient. Now, the parallel argument to this is that the business owner themselves is going to spin up their own software on Claude and rip out their own systems and say, thank you for the 20-year relationship of running my mission critical software that worked without issue every day, but I'm going to actually replace it with my own because I'm tired with this expense line item that is 1% of my business yet runs my entire business. And I'm going to put in my own Claude code created software and retrain my entire employee base and just hope that there's no mistakes or errors in it because I'll have no idea how to fix that and I will be out of business if there's literally a mistake in the code. Is that kind of what people are thinking is going to happen? It's just very bizarre. And I've talked to, business owners rather have commented to me that they'll use some legacy software offering and they'll say that there's no way in heck that I'm ever going to replace this with something that I generate myself or someone else generates. And if someone else generates it, I care about the service and I care about it being a better product. So it's just such a really, honestly, ludicrous proposition. I get it. AI is scary. AI can get better over time. It could get to the point that you have an AI agent just spin you out an entire software product. But if you are a business and your entire revenues are dependent on this, it is your entire business operation, you are not going to want to take a risk with this. Right now, many of you are finance people. You use Microsoft Word, you use Excel. How many of you have went to Claude to just try to vibe code your own Microsoft software or Excel and say, I don't want to pay them anymore. I don't want to pay Microsoft Excel. That's a waste of my money. I'm going to just vibe code it and have my own Excel software. It's kind of just a ridiculous thing. And I'm willing to bet that not a single person watching this video has ever tried that or even thought to do that because that is not how most people actually behave. Coca-Cola is a very easy product to copy. In blind taste tests, people have made better tasting beverages than Coca-Cola by far. Their moat does not lie in the product. It lies in the distribution and the product recognition. It is similar here. The moat lies in the distribution and the reliability. It doesn't have to do with the fact that someone else maybe even could make a better product because you don't even need AI to make a better product than many of the existing vertical market software solutions. If you pull some of these up, it looks like, legacy 1990s or early 2000s, Microsoft software. It does not look pretty. The point is it gets the job done. And once it gets the job done, there's nothing else that they need. You're not providing any other benefit. And if you're not providing any other benefit, they're not going to switch. Again, Peter Thiel says that you need something 10 times better. And it's not 10 times better. In many cases, it could be worse because you don't have a service element to it. You don't have the reliability element of the software actually being tested over the past decade and working. And so that is just some of the reasons why I am really, to be honest, a little dismissive of this idea that AI is going to change the vertical market software landscape space. Now, will change, potentially different factors in the horizontal software market. That's a different deal. We could talk about that. But with vertical market software, this is a $5 million TAM you're going after, and you still need that service element of helping the client. And even if you are an AI first software company, you maybe have one or two less software engineers, but you still need sales and support. And so even if your product's a little cheaper to make, the business isn't any better and the overall value prop isn't any better. And so that's enough of my rant on that point. The AI risk personally, for vertical market software companies, I'm not that worried about. I actually think if anything, and if AI is that great and gets that strong, then Constellation Software is the one who's in the position to offer better software to their existing customers using AI. They already have an entire employee base of software engineers, and it's not like they don't know how to use AI better than, the potential dentist does, or they're not in a better competitive position after being that integrated than, a newcomer AI first software company. And so it's a little silly of a proposition, to be honest. And so that is the AI risk. That is what I think about it. If you think I missed something there, drop a comment below. We can address that. But Mark Leonard stepping down in the optics of it, I'm not going to lie, it wasn't great because they do this AI call. For those that don't know, Constellation Software famously does very, very little press releases, investor relations, any of that. He stopped writing basically regularly. In 2017, his copycats came up. Then he wrote one letter in 2021, right in the kind of the aftermath of COVID, and really stopped all sort of investor letters. And also, quarterly earnings calls stopped much, much earlier before that. And they just do one annual general meeting. They made an exception. They had this kind of AI call where they talked about AI. And the way they basically talked about it was they said, it's kind of a risk, but we're not that worried about it. But we don't know for sure, until things actually unfold, which is honest, and it's how they communicate. They don't feel a need to dress things up. They are very intellectually honest. And by the way, it was a similar thing when the SaaS sort of transition happened a while back. What ended up happening was that they had a lot of on-prem software, and people thought the fact that it was on-prem with hardware, now everyone's going to want SaaS, is going to mean the death of their business. Sort of a similar dynamic. And what they said at the time was, if people care that much about SaaS, we can transition to SaaS, but we just don't think our customers care that much because what they have is working. And that basically ended up being true. They did transition to SaaS over time, and even more so over the last few years, and it just wasn't this huge deal to the business. And with the AI thing, the other thing to keep in mind is that this transition from on-prem to SaaS basically removed the need for all of these businesses to have their own IT departments in their own sort of technology in-house capabilities. And that was not something the average business wanted or needed to have. If you think about starting a business 20 years ago, very often you needed an IT department to manage servers in-house. Of course, AWS and the cloud changed this, and you just outsource that to a different cloud provider. Now you don't need to have an in-house IT department. With AI, people are kind of suggesting now there's going to be a reversal of that, and people are going to in-house that themselves though, and want to have their own person in their own business in charge of the software, or perhaps more ludicrous that the business owner themselves, who's never built any software in their life, is going to be able to just type something into a Word box and get software that works 100% of the time. Because if it doesn't work 100% of the time, it is useless. Because if it only works 99.9%, they're going to have no idea what to do in that 0.1% of the time when it breaks their entire business. It's such a bad risk-reward proposition. And so all of this, he's kind of talking about AI on the call. They're pretty open-ended though, and they're saying that we don't really know for sure. We don't think it's that formidable of a threat. We don't really see how. And on top of that, we think it's actually an opportunity because maybe it'll help us grow more. They've never really been able to grow organic growth that much, even though they've tried to. And so they're like, maybe it could be an opportunity. And they kind of left it as that, didn't mention Mark Leonard's health. And a few days later, he steps down. And then Mark Miller is appointed as CEO. And so wasn't the best optics. Rumor has it though that he has serious health problems and won't be around that much longer. We don't know a lot of details. We don't know how sudden this was. And maybe in his mind, he's like, this is one of the most formidable risks to the business. I want to make a comment on it, and I want to just quietly step down. I don't want to make this whole meeting about my health because I don't want to talk about it. He's always been a very, very private person, really rarely doing interviews or anything like that. I actually was pretty surprised when he did respond to our email when we sent him our research report, and he did note that it was pretty thorough, which I was really excited to hear from him. But he's always been very private and not communicative outside of the annual general meeting. And so the new CEO, Mark Miller, though, he is not a newcomer. He's someone who's been at the business since 1995. He was there since basically the first acquisition ever and is now running the company. And the other thing that's kind of different about the business versus like Berkshire Hathaway is that all of the capital allocation decisions are distributed down by and large. And so the way it works is that each of the operating groups, they have kind of business units under them, and the business units under them have companies under them. And the companies that generate capital kick that capital up to a business unit. Then the business unit can decide whether or not there's opportunities to reinvest that capital, or it gets kicked up to the operating group. The operating group can then move it somewhere else within that operating group and reinvest it. Or if they can, it gets kicked back up to Constellation Software. They created incentives to try to make sure the capital moves down as much as possible instead of up, because they want the boots on the ground to be making these capital allocation decisions. The exception to that is decisions over $20 million, at least last they disclosed. Maybe they raised it a little bit, but anything over $20 million, it goes up to headquarters, and that's when they talk about it. So like the Allscripts acquisition, that was Constellation Holding Co. making that decision, not, an individual business unit. But they want the business units making those $5 million, $10 million acquisitions as much as they can, as long as they're meeting their hurdle rates. And so that's kind of the idea, that if you want to know more about how all this works, I actually interviewed someone who was a head of M&A at Constellation Software. It's on that same podcast, so you could find that in the feed. Really great, interesting interview with him. And it's very hard to get information about Constellation Software. So let's wrap this all up. What does this mean for investors? What does this mean for valuation and all of that? So you have a business that's been, growing high teens revenue for a very long period of time. Yes, a lot of that is acquisition driven, but there's also no signs that acquisitions are going to slow down anytime. Total free cash flow deployed in the past couple of years has been at over 100% a year. And how that's possible is they've been taking on a little bit of debt to do these larger acquisitions. Yes, it's a little bit lumpy. LTM, it's only 80%, not the 120% it was there the year prior, but they're only, one of these bigger acquisitions away from that totally changing. And they have built up a very long track record that you can trust they'll be able to continue to find these opportunities. But of course, that is a key thing for investors to decide for themselves, whether or not they think they're going to be able to continue to redeploy a lot of their capital. Now, in terms of the return on invested capital, that's also held up at 20% or higher. But if they do these larger acquisitions, are the returns going to fall in the future? Do they lower the hurdle rate? Maybe, maybe not. Mark Leonard has basically said that he doesn't want to. They flirted with the idea of lowering it for larger acquisitions, and then said they don't want to do that. And so they just want to hold the return on invested capital as high as possible. And so that's something to kind of keep in mind there. Now, in terms of capital allocation, very interesting. They've never bought back stock. There's the same 21 million shares outstanding. They also don't issue stock-based comp to employees. In fact, it's the opposite. They force employees to spend about 70% of their after-tax bonuses on the stock. And so they have to pay out in cash. I think that with the stock down so much, some employees probably not so happy. At the same time, though, the stock, he's talked about it, has kind of been a little lofty for some period of time. And so now this, if anything, could be a better opportunity to retain talent, because they're going to want to put more money into the stock at these lower valuations. In the future, and especially with Mark Leonard gone now, it's possible they do actually end up buying back their own stock, which could be sort of another kind of avenue of value creation, as long as they're not overpaying for it. Now, today's multiple I mentioned is 21 to 22 times free cash flows. Where that number comes from is Mark Leonard has his own kind of free cash flow available to shareholders metric. I trust that metric. One of the key differences is that they're pulling out minority interest. So that makes sense to do, because free cash flow is, of course, always at a consolidated basis. And so that number, there's one other adjustment you have to do, which is adjust out something called the IRGA liability. I talk about that in the podcast, more link below. In short, they are going to be forced to eventually buy a big share of Topicus, which is one of their operating divisions. You want them to do that because it's at a good valuation, but basically as that valuation changes, it flows through on the cash flow statement, but it's going to be a one-time sort of payment. So you shouldn't put a multiple on that, because it's going to go away the next year. So adjusting that out, basically 21 times, 20 times free cash flow at a stock price of around $2,000 today. And so for that, you're getting a company that, at least historically, has been growing free cash flows at a high teens % per year. So if you're thinking about that, 20 times multiple is about a 5% earnings yield. And then you're also getting high teens free cash flow growth on top of that. And so that's going to be on an investor to decide whether or not they agree with some of these AI risks and kind of the things we've talked about, or if they think it's more formidable of a challenge, and whether or not they believe that an acceptable return is there for the risks that are perceived. Now, again, there in that podcast link below, a lot more on Constellation Software. You could also go to speedwellresearch.com to get the report. But if you want another stock breakdown, go ahead and check out this video we just did on Novo Nordisk. Also, another stock with a big turning point right now. And so very similar sort of inflections happening in the business. You could check that one out here. Or if you want a different one, check out this one on Uber.